Our next reading is non-current liabilities or long-term liabilities, and these are the specific learning outcome statements. We will briefly overview all of these and then we will move on to the questions. First, LOS says, determine the initial recognition, initial measurement, and subsequent measurement of bonds. What are bonds? Bonds are a principal form of long-term debt. When company needs money, governmental bodies need money. So this is how they raise their finance, through issuing bonds. So there are source of finance for corporations and governmental bodies. So basically there are two parties. One that issue bonds and the other party that buys bonds, or they are called the holders or investors. So it's issuer, holder or investor. So bond basically it's a formal contractual arrangement between these two parties. And under this contract, under this arrangement, the issuer is obligated to pay the face value, sometimes called the maturity amount, sometimes called the par value of the bond at maturity, together with interest payments at stated intervals. Sometimes there is no interest in case of zero coupon bond. So remember, it's a contractual obligation, it's a contractual arrangement between the issuer and the bondholder, where the issuer will repay the par, the face value or the maturity amount to the holder at the expiration, at the maturity of the bond, and it will also be accompanied with periodic payments of interest in most of the cases called coupon. The rate of interest given to the bondholders is called the coupon rate. It is also called the stated rate. Okay, so debt issuance could be of three types. Bonds issuance basically. Bond issued at par, bond issued at discount, and bond issued at premium. In case where your coupon rate is equal to the market rate of interest, you are offering 5% interest rate on your bond, and at that time the prevalent market rate was also on similar type of instrument was 5%. So when your coupon rate is equal to the market rate of interest, your $100 bond will get you $100 at issuance. Why? Because the coupon rate is equal to the market rate of interest. Right? We'll see through computations. But when your coupon rate is 5%, but at the time the market rate of interest is 8%. Since market is offering more, your bond is giving less. In this case, the buyer will be willing to pay less. Investor will pay less than the face value. So probably your $100 bond with the par value, the face value, might sell for, let's say, $87. How this amount is determined, we will calculate. In the last case, the bond issued at premium. When your offered rate, your coupon rate, it is greater than the market rate of interest, you have offered 8%, whereas the prevalent market rate for similar instrument is 5%. Investor will be willing to pay more than the face value. So your $100 par value bond might sell for $115, let's say. So it's all about the interplay between the coupon and the market rate. Let us do it through some computations. Let us consider an example. FTC Incorporated issued $100,000 face value 5 years bond on 1st January 2021, when the market interest rate on bonds of the comparable risk and returns is 5%. The bonds pay 5% interest annually. That's the rate at which we will pay, and the market rate happens to be 5 as well. Now what will be the value of the bond? Because since your offered rate, coupon rate is the same as the stated rate, so the par will be the issue price. So if you plug in your financial calculator, the term is 5, effective rate per period is 5, present value is to be calculated, interest payment will be 5% of the face value, that is 5,000, and the face value that will be redeemed at maturity is $100,000. If you plug in all these numbers, you will get the present value of the bond. Basically, the value of the bond is equal to present value of the coupon payments, present value of the interest payments, plus present value of the principal, the face value. Since we don't have to calculate the individual interest payments present value or the present value principal, our calculator will do it for us. So if you plug in these numbers in your calculator, you will get your result. So 5 represents N, 5 represents interest, payments 5,000, and your face value, if you calculate PV, it's exactly $100,000, and that's shown exactly here because your interest expense and your interest paid, they're the same. Remember, interest expense is calculated at MRI, market rate of interest, or the investor desired rate of return if given, and interest payment is made at coupon. So your interest expense is $5,000 as well as your interest payments $5,000. So a par value bond has been sold at $100,000. So remember, when the bond is issued at a rate which is equal to the market rate of interest, par value and the proceeds we receive, the present value, they are the same. What about the bond issued at discount? You will see. FTC Incorporated issued $100,000 face value 5 years bond on 1st January 2021 when the market interest rate on bonds of comparable risk and return is 8%. Market rate is 8%. But the bonds we are issuing, they are offering a 5% coupon. So our offered rate is less than the market rate of interest. So this face value will fetch less amount. How much less? Let us use the financial calculator. We have N5. Rate for discounting is always MRI. Present value is to be calculated. The payment is we are making is 5,000 per year. Future value or the face value at which the bond would be redeemed is 100. If you plug in these numbers, all right, so 5 is N, 8 is the interest rate, 5,000 is the payment, $88,021. 88,021. This would be the cash received on the bond issue. Why did you receive less than $100,000? Because your coupon rate is less than the market rate of interest. So you got less than the face value of the bond, 88,021. Now let's see how the bond discount is amortized over the time. So the difference between the face value and the money received, the difference about 12,000 something or 11,000 something. This is called the discount on bond issue. How it is accounted for? Remember, interest is paid at the coupon rate 5,000. That is 5% of the par or the face value, 5,000, 5,000, 5,000, 5,000, 5,000. But the interest expense charged to income statement is carrying value multiplied by the effective rate, which is 8% or market rate. So it's 7041.75. This is what goes to income statement. This is what you pay. The difference between the interest expense and interest paid, the difference is the discount amortization. This is the discount amortized. This amount will be added to the opening balance of the bond. The closing will be 90. Next year, the interest will be 90,0630 times 8%. This is the interest expense to the income statement. This is the interest payment. The difference between the expense and payment is the discount amortization. This discount amortized in the next year will be added again. So what you see, the bond that was issued at 88,000, this discount being amortized will take the carrying value back to the par. So at the time when the bond matures, the book value will be equal to the par value. Right? So remember, when the bond is issued at lower rate than the market rate of interest, it will be sold at a discount. The discount, the difference between the face value and the issue proceeds, this is amortized over the term of the bond, and this amortization is eventually added to the carrying value, and at maturity, the bond's face value will be equal to the value that you carry in your balance sheet. Next, bond issued at premium. FTC Incorporated issue 100,000 face value bond, 5 years term, 1 January 2021 was the issuance date when the market interest rate on the bond of comparable risk and term was 5%. The bond pays 8% interest annually on 31st December. Now this time, the market rate of interest is 5%, but you're offering a coupon of 8%. Your rate coupon is higher than the rate in the market, so the bond, $100,000 bond, will sell at a higher price. What will be the value you will receive? Can be calculated using the financial calculator. 5, rate to be used for discounting 5. Interest payments will be 8,000 per year, and the face value when the bond is redeemed is $100,000. Plug in these numbers and you'll get your result. N, 5 market rate of interest, 8,000 is the interest payment. You can write negative with it, and finally CPT present value, it's 112,988.43, and that's exactly what you have, 112,988.43. This is the value to be recorded on the balance sheet because you received more than the face value, the par value of the bond. Why? Because your offered rate is more than the market rate of interest. Now what will happen? This difference, 12,988.43, it is called the premium on bond issue. This premium will be amortized just like the way we amortized the discount in the previous example. Total of all these is equal to the difference between the issue proceeds and the par value of the bond. Same is true here. When this premium will be amortized, the total of the premium amortized will be equal to 12,988.43. How does it work? As I said, interest is paid on coupon times par value. This is the coupon, 8%. So 8,000, 8,000, 8,000, 8,000, 8,000. But the interest expense is the carrying value times the MRI, that is the market rate of interest. So this is your interest expense. This is the interest payment. The difference between the interest payment and the interest expense is the premium amortization. This premium amortization every year will reduce the carrying value of your bond, and at the date of maturity, your carrying value will be the same as the face or the par value of the bond. So you just saw in the previous example that a discounted bond went up from $88 to $1,000, and a premium bond also fell from $112 to $100,000 at the date of maturity. One important point also to be noted is that discount amortization amount increases every year. Same is true for premium. Premium amortization also increases every year. You might be tested on this in some questions. So this was your LOS 1. Next, this all discuss bond issued at par, bond issued at discount, bond issued at premium. Next, financial statement impact. When you issue bond, of course you receive cash, so it will increase your assets, and at the same time you have to book the liability. In case of a par bond, this would be the value of liability at the start of the period. In case of a discount bond, this will be the value which will keep on increasing every year as the discount is amortized, and in case of a premium bond, this will be the original liability booked, which will close out at the end of the bond term to $100,000. Right? So this is the impact. Assets go up because of the issue proceeds in the first year, and the liability goes up by the time when the liability is to be settled at maturity. So liability is closed by debiting it and crediting the cash at a redemption point. So that completes your LOS 1. Next, describe the effective interest method and calculate interest expense, amortization of bond discount, premium, and interest payments. That is exactly what we have done. We have used effective interest method to amortize the discount premium, and discount amortization and premium amortization. There is also another method which we can use to amortize the discount and the premium. Like for example, what we did here, we use the effective method. This is the amortization which is increasing every year. There is also another method to amortize the premium and discount, is to use the straight line method 12,988.43 and divide this premium amount equally over 5 years. So what you will see, instead of these different premium amortizations, you will see a single number every year. Same is true for discount bond. The total of the discount, let's say if it's 12,000 for example, so this 12,000 discount will be amortized in a straight line manner in equal basis. Your interest paid and your discount amortization will be the same. What we have used here in this example and the next one was the effective interest method, where we use the discount rate and calculate the amortization accordingly for discount and for premium both. So I think this has already been covered in the previous LOS. So zero coupon bond, as the name suggests, these bonds carry no coupon. Then who would buy in their right mind? These bonds are issued at deep discount. A $100 par value bond might be issued at $80. Right? I will buy a bond at $80. There is no interest, but by the time the bond matures, I will get $100. So basically the difference between the price I paid and the price I received, the amount I received at a redemption, this $20 represents my interest income. So zero coupon bond involves no periodic interest payments, but this difference of $20, the organization will charge it as an expense in the income statement. Then what about the bond issuance cost? Bond issuance is very expensive activity, just like getting a company listed is an extensive, time-consuming, costly activity. Those of you who have been involved in registration listing, I'm sure you would know it takes months, 6 to 7 months, many sleepless nights, millions of rupees and millions of dollars are involved in getting a company listed. Similarly, the bond issuance is also costly. So what do we do with the bond issuance cost? Bond issuance cost in the US GAAP, it is capitalized as an asset. For example, you spend $5,000 for legal costs, for registration with the SEC, etc. So this 5,000 bond issuance cost will be capitalized and it will be released as an expense in the income statement over the period of the bond. Let's say if it's a 5 years bond, this 5,000 will be amortized over the term of the bond. Whereas in IFRS, what we do in IFRS, we net this $5,000 from the bond proceeds. Like we reduce the liability. Let's say the bond was issued for $107,000 and this $5,000 of issuance cost is netted against this and liability is booked at $1,000 or $2,000. So in IFRS, the issuance cost is netted against the issue proceeds, whereas in the US GAAP, the issuance cost is debited and capitalized and amortized over the period of the bond, the term of the bond. Right. Then, next is extinguishment of debt or de-recognition of debt or bonds. It's all the interplay between the book value and the fair value. Normally when the bond is issued at discount or premium, at maturity, the book value and face value, they become same. But what if during the period, if the bond is under the indenture, we can, as an issuer, if we can redeem the bond, we can extinguish the bond within the life of the bond, if it is allowed in the indenture, then what can happen? Let's say if the bond in the books is carried at $97,000. The value at which it is operating in the market or trading in the market is, let's say, $99,000. Now, if you de-recognize this bond by extinguishing it, the difference between the book value and the fair value, you have to pay $2,000 more. This $2,000 will be considered as a loss in your income statement. This is called loss on redemption. Likewise, if the if the loan or the bond you're carrying in your books is at let's say $97,000, but the fair value at which it's currently trading is 95. So if now you redeem the difference, 2,000, you are discharging a liability of $97,000 for just by paying $95,000. This $2,000 will now be gain on redemption and it will be reported as a gain in your income statement. Right? So that's the idea. So when the bond is de-recognized, it is more or less likely that your book value and the fair value might not match, so the difference could either be the loss or gain at redemption. So what do we do for unamortized issuance cost? If you redeem, let's say a 5-year bond is being redeemed in the 3rd year, in the US GAAP, you will still have some amount unamortized. So in the US GAAP, it is charged against gain and loss in the US. Whatever was unamortized amount of issuance cost, it will be adjusted against the gain or loss on redemption. But in IFRS, since this issuance cost has already been included in BV, so there won't be any issue in the IFRS. So the issuance cost, unamortized one, it will be adjusted against the gain or loss on redemption. But in IFRS, there will be no such issue. Why? Because this loss was already, or this cost was already embedded in the liability. Now we have another option to book the liability related to bonds in our books. That is, we can carry the bonds rather than at the book value. These are the book values at which we were carrying the liability on our balance sheet. This is the value to be reported at the 1st year, 2nd year, 3rd year, 4th year. These are the closing carrying values in case of discounted bond, and these are the closing carrying values in case of a premium bond. Right. There is another alternative equally valid for the US GAAP as well as under IFRS. We can carry the bonds at the market value. Bond can be reported just like securities held for trading securities are reported at fair value. Available for sale debt securities and the redeemable preferred stock is reported at fair value. Their gain and loss is treated taken into OCI. So we have discussed this in detail in our marketable securities. Likewise, bond can be taken at fair value accounting. This is acceptable both under IFRS and US GAAP. Let's say the last year's bond valuation was, as per the market value, was 100, 500. At the end of the balance sheet date, next year, the value fell to 99, 500. Now this difference will be treated as a loss in income statement. So any fair value gain and loss is reported in income statement. And of course, it will affect your balance sheet numbers, and accordingly, it will affect your ratios as well, depending upon whether the liability has gone up or down. In this case, liability has fallen, so it will affect your gearings, it will affect your leverage ratios, your solvency ratios. So accordingly, you can see that you have read many the example there. Now, what about debt issuance covenants? Covenants are restrictive clauses, restrictions placed on the lender that what he can or cannot do. So covenants are the restrictions imposed upon the issuer that what he can or cannot do, or what he should or what he shouldn't do. Affirmative covenants, as the name suggests, affirmative covenant means that borrower, the issuer, promises to do certain things. He will do certain things. He will make payments of interest on time, he will make the payment of principal on time, and he will maintain the asset collateralized in good condition. So affirmative covenants mean these are the things that the issuer promises to do under the bond indenture. Negative covenants, as the name suggests, these are the restrictions on the issuer. Issuer must abstain from certain activities like issuing dividend beyond a certain limit agreed, issuing more debt. So these are the restrictions that might be placed on the issuer through affirmative and negative covenants. What is technical default? When any of the bond's covenants are breached, violated. So if covenants are violated, the bondholder under the law can demand immediate repayment of the principal. So technical default means if you are in violation of any of the covenants of the bond, then under the law, bondholder is entitled to claim the immediate repayment. Right? That term must be remembered. Now, next, describe the financial statement presentation and disclosure related to debt. So most of the disclosures would be in the footnotes and MDA. What will be the disclosures? Maturity dates, patterns of maturity dates of different bonds issued, stated and effective rates, that is coupon and the MRI, Call provisions, if the bond contains a call provision, thereby entitling the issuer to call the bond before maturity. Conversion privileges, certain bonds are under the agreement or under the nature are allowed to be converted into certain number of shares after a certain period of time. That needs to be disclosed as well. Any restrictions imposed by the creditors, which specific assets have been collateralized against the bonds, and amount of debt maturing in each of the next 5 years. These are the specific disclosures required in your LOS 5. Explain motivation for leasing assets instead of purchasing. What is leasing? Leasing basically is an arrangement just like bonds. Leasing is a contractual arrangement between two parties, the lessor and the lessee. Lessor owns the property. He gives the right to use the property to lessee under an agreement in return of periodic payments, to put it simply. So it's a contractual arrangement between the owner of the property and the one who wants to use it for a stated period of time against stated amounts to be received by the lessor. So why do we lease? The question, the LO says, explain motivations for the leasing assets. Why do we lease? Just small periodic payment is needed to obtain the right to use the asset. It's less costly than a loan or for buying an asset. So leasing is comparatively less costly as regard to cash flows are concerned. Less restrictive provision, because if you take loan, there are more restrictions. So there are comparatively less restrictions under leasing, and you avoid the risk of obsolescence. If you have acquired an asset under lease, after 3 years, and if it's cancelable lease, you can cancel and take a new contract of lease for new asset. So if you buy an asset under ownership, you face the risk of obsolescence. Your asset might become obsolete because of technological innovations. Under leasing, you can always come out of the lease agreement if it's cancelable, and you can enter into a new agreement to purchase, to take on lease a new technologically improved asset. So this is a very major advantage, a major motivation for leasing. Risk of obsolescence is avoided through leasing. Your next LOS, explain the financial reporting of leases from lessee's perspective, and then the next one will be from lessor's perspective. First of all, these are the specific criteria under the US GAAP. If they are met, the lease will be classified as a finance lease for the lessee and a sale type lease for the lessor. Let us read these specific criterions. This is not included in your syllabus. I hope not in curriculum as well. If any of the 5 criteria there before, in the previous standard, in the US GAAP, there were 4 conditions. Now they have added this new one. So if any of the 5 criteria is the lease is finance lease, if any of these is met, the lease is a finance lease. For lessee, it's a finance lease, and for the lessor, it's a sale type lease. What are these conditions? Transfer of ownership, it will be finance lease for the lessee and sale type lease for the lessor. Option to purchase, if the lease contains an option to purchase, the bargain purchase option, and that option is reasonably be exercised by the lessee. In that case, it's a finance lease for lessee and sale type lease for the lessor. Lease term is greater than 75% of the economic life. Let's say the asset's economic life is 10 years and the lease term is 8 years, effectively meaning 80% of the life of the asset will be under lease. If this criterion is met, again, it's a finance lease for lessee and sale type lease for the lessor. If the life and 70% of the life of the asset is covered under lease, like in this case, it means almost all of the life is under the lease then. So in that case, it will be finance lease for lessee and sale type lease for the lessor. 4th criterion, the present value of the lease payments plus any residual value guaranteed by the lessee. Let's say if the asset has a fair value of $100,000 as the inception of the lease, the lessee will make certain lease payments. The lessee has also agreed to pay certain residual amounts to the lessor. If we discount all these future payments and the residual value guaranteed by the lessee, and those payments present value is greater than $100,000, let's say if it's $1 or $2,000, or let's say it's $100,000, then such a lease will also be called as a finance lease. So it means the present value of the lease payments and the residual value, if it is greater than or equal to the fair value of the asset, the lease will be finance lease for lessee, sale type lease for the lessor. This is US GAAP, gentlemen, remember. And this is the new criterion added under the new leasing standard. The asset is so unique and special that it has no alternative use for the lessor. So if the lessor has leased this asset to you, and for the lessor this asset has no alternative use, if this criterion is met, again the newer one, it's a finance lease for lessee and sale type lease for the lessor. If none of these criteria is met, when none of the above criteria is met, lease would be operating lease for the lessee and operating or direct financing lease by the lessor. And when the direct financing lease will be considered DFL only if the criteria for this one is met and it's probable that the lease payments plus residual value will be collected by the lessor. So if criteria 4 and the collectibility of residual value is guaranteed by third party, then it will be considered as a direct financing lease. So this is the new criteria in the US GAAP. What about the IFRS now? IFRS doesn't have these categories anymore. Finance and operating lease criteria is treated as same in IFRS. Let us discuss these one by one. Under IFRS, right to use asset versus short-term lease. When you say right to use asset, this incorporates your finance lease and operating lease. Accounting for finance and operating lease is the same now. Previously, operating leases were just rental payments of certain lease asset. But now the operating lease accounting and the finance lease accounting is the same. There is a small difference of treatment of assets under the operating lease. Now, every leased asset, other than the short-term lease, every leased asset, whether it's a finance lease or an operating lease under the IFRS, is to be reported on the balance sheet. Instead of debiting the asset, the right of use asset is debited. Initially, it was the asset debit, the liability credit. Now we debit the right to use, not the asset, gentlemen, ladies, not the asset itself, the right to use asset. Specific terminology of the standard. So, right to use asset versus short-term lease. Short-term lease is treated like a rental arrangement, but other leases, operating and finance, they are treated same in IFRS. You book asset and liabilities. Two parties in each lease. There are two parts. The lease payments you make, there are two parts to each payment. The one is the principal part, the remaining is the interest. And the short-term lease is considered as a rental arrangement. And interest paid, the payment of lease that you make, there are two parts to it. One is the principal and other is interest. This interest part under the IFRS can either be reported as a cash flow from operations or cash flow from financing. But under the US GAAP, I'm sure you remember, the interest payment are always reported as CFO, cash flow from operations. So finance or operating lease criteria we have discussed in the previous slide. Initial recognition for finance and operating lease under the US GAAP is the same. Initial recognition is of liability is the same. Whether it's a finance lease or operating lease under the IFRS, under the US GAAP, leases are now operating or finance are to be reported on the balance sheet as a right to use asset and the liability. So it means no longer leases would be hidden in notes. Leases now will be reflected on the face of balance sheet under the right of use asset. So initial recognition is the same for finance and operating lease. Recognition of liability is the same. It is just the treatment of assets under the finance lease and operating lease are different. Gentlemen, it needs me 2 hours to explain you leasing in detail. It's a topic that we discuss in CM in much more detail with 30 to 35 questions on leasing alone. So I don't want to jump deeper into it. You just need to have an overview, because what you will see as an analyst is on the balance sheet, how it has been accounted for, how the minimum value, minimum lease payment has been calculated, how the criteria has been met, which criteria has been met. This will be much deeper thing, which I think you don't need that. What about lease accounting for lessor? Under IFRS, finance and operating lease criteria are applicable on lessor. You didn't see this finance and capital lease here for the lessee. Lessee has right to use asset and short-term lease. Maafi finance lease and operating lease for IFRS lessees. But for the lessors, he can either report it as a finance and operating lease. Asset is removed under the finance lease. Of course, it is no longer, it is treated as a right to use asset by the lessee. Interest portion of lease is income under the finance lease. Interest part, whatever the payments he is receiving, the interest part is his income. For operating lease, lease rental is an income. Short-term lease will be considered, any amount he is receiving under the short-term lease, it is considered as income part of it. And if it is under the operating lease, it will be reported as an asset for the lessor, and he will charge depreciation accordingly. For the US GAAP, there are three categorizations: sale type lease for the lessor, direct financing lease, and the operating lease. We discussed the criteria of sale type lease. If any of these five criteria are met, 1, 2, 3, 4, and 5, so it will be considered as a sale type lease for the lessor. If not, then we have the direct financing lease, and that we discussed in the previous slide as well. So when none of these criteria are met, then the lessor has the option to treat it as an operating lease and report it accordingly. Now we have types of pension plans. Just an overview. We won't be going much deeper into detail. Pension plans, basically, company maintains two types of plans. One is the defined contribution plan and one is the defined benefit plan. The difference between these: under the defined contribution plans, company contributes a specific amount into the plan every period, and it is treated as an expense in the income statement. A certain amount into the contribution plan for the benefit of the employees, and it is treated as an expense. So since it's considered as an operating expense, so any payment made for defined contribution plan, it is considered as a cash flow from operating activities. But defined benefit plan, it's a much more difficult, complex area, and of course we have just been given a couple of paragraphs in your capital notes, and of course it's not extensively discussed in your curriculum as well. What you need to know that defined benefit plan is more complicated, much more complicated than this one, because in this arrangement we will be accumulating two things simultaneously: the plan assets and the estimated obligation under the defined benefit plan. So it's a much more difficult accounting for this. So what exactly we need to know is that under defined benefit plan and defined contribution plan, what are the specific disclosures and representation on financial statements? That's what we need to know. So just remember, this is just a regular payment, periodic payment to the plan for the benefit of employees, and the payment is considered as an expense and an operating outflow from your cash flow statement. But the defined benefit plan is comparatively complex. We have given some details here. Recognition of defined benefit plan. Most of defined benefit plans are funded through pension trust funds. They manage the defined benefit plan. As I said, there will be two accumulations in two different accounts. One is the plan assets, other is the estimated obligations, estimated pension obligations. If the fair value of the plan assets is greater than the present value of pension obligations under the plan has surplus, so balance sheet will reflect net pension asset, because we need to only understand the disclosure of these plans. Detailed accounting is not given anywhere in your reading. So we will see a net pension asset when your plan assets value, fair value, is greater than the present value of pension obligation. Conversely speaking, if the fair value of the plan asset is less than the present value of pension obligations, the plan has deficit. So the balance sheet will report a net pension liability. Most of your questions in your Kaplan and almost all questions in your EOCs are related to these two things only. No other computations are needed, so we don't need to jump into deeper details. Just like in leasing was done superficially. As I said, leasing is quite a detailed topic, and we have just done it hardly 5 to 10 minutes. And then some components of defined benefit plan are included in net income, while others are recorded in other comprehensive. If you remember, we discussed there are 4 components of other comprehensive income: available for sale debt and preferred stock securities gain and loss, effective portion of cash flow hedge, translation gain and loss, and one of them was the defined benefit plans gain and loss. That was reported as a part of OCI. So I hope you can relate this topic to that one. So Some elements are reported as a part of income statement, and this one specifically is reported in other comprehensive income. Treatment of these cost components are similar under IFRS as well as US GAAP. This is just a brief on the very complex topic, so you might feel little, left out, but that's what you need. No need to go any further. Next, ratios. Calculate and interpret leverage and coverage ratios, that is solvency and coverage. We have done these earlier, but let us just have a quick overview. Solvency ratios give information on firm's financial leverage and ability to meet its longer term obligation. We have a couple of ratios. Debt to equity, we discussed previously in our financial statement and analysis techniques. Total debt upon total shareholder equity. If this number is higher, it means the business has solvency issues. Debt to capital, total debt upon debt and shareholders equity. Higher number indicates the company has solvency problem. Debts, total debt to total assets. So technically this and this ratio is the same. The denominator here contains the equity and debt, but this contains total assets. So these are the ratios we discussed in detail, solved many questions in our previous reading. So these are solvency ratios. Coverage ratios, we have already done these as well. What they measure: sufficiency of earnings to repay interest or other fixed charges. Do you have sufficient earnings so that we can make comfortably the payments that we are required to for interest and fixed charges? This was for financial leverage. This one, earning before interest and tax upon interest payment. Let's say if you have $100,000 earning and your interest payment is $10,000, we can comfortably pay our interest 10 times, even we have to pay once only. So this shows the level of comfort with which you can make certain fixed payments. This one is fixed charge coverage ratio, earning before interest and taxes plus lease payments divided by these fixed payments, and again, higher the number, the more comfort you have in making such fixed payments. So these are coverage ratios discussed much more in detail in your previous readings. So that's all for non-current and long-term liabilities.